Last week, Rosenberg Research did something they only do in emergencies. They issued what they called a nuclear report. The title, Canadian Economy on Life Support. Not slowing, not cooling, on life support. And while the Bank of Canada keeps telling you everything is stable, the real numbers tell a completely different story. The economy didn't just slow down in the last quarter. It shrank by an annualized 0.5%. Your retirement portfolio just took a direct hit from an economy that's not recovering, it's contracting. The official explanation? Temporary weakness, a little blip, nothing to worry about. The real reason? A mathematical impossibility that politicians and central bankers have been papering over for 3 straight years has finally broken through the surface. And this isn't about economic theory or abstract data points. This is about your 401k, your pension, your real estate equity, and your ability to protect wealth during what's coming next. In the next 30 minutes, I'm going to show you 3 things. First, how Canada's output engine has been quietly dying for 3 years, while the media celebrated fake growth numbers. Second, how the per capita collapse has entered what economists call a disinflationary output gap, a phase that doesn't end until someone's wealth gets destroyed. Third, how this structural fracture ends with a currency reset, a pension crisis, or a real estate meltdown that will make 2008 look like a practice round. And by the end, you'll understand why this isn't about Canada's trade numbers or unemployment headlines. It's about your retirement savings, your mortgage risk, and your family's purchasing power in an economy that just admitted it's been running on fumes. This is vanishing in real time. To understand what just happened with Rosenberg's nuclear report, you can't start in 2026. You have to go back to 2020 when the pandemic hit and central banks everywhere made the same decision: print money, freeze the economy, and hope that when things reopened, growth would snap back like a rubber band. That's when they built the paper recovery, a system that let them create the appearance of expansion where only contraction existed. For 3 years, the headlines celebrated GDP growth. But nobody mentioned that GDP per person was falling. Nobody explained that the growth was just population increase masking economic death. Here's the part they never put in the official reports. Canada added millions of people between 2020 and 2025. The population surged, immigration exploded, and on paper, total GDP went up. Politicians pointed to those numbers and said, look, we're growing, but divide that GDP by the number of people, and the story flips. Output per person dropped. For 5 of 6 quarters through 2023, real GDP per capita fell. That means the average Canadian got poorer every single quarter while the government celebrated growth. The mechanism hiding in plain sight was simple: more people sharing a shrinking pie. And the media never asked the question that mattered. If we're growing, why is everyone broke? Let me be precise. This isn't a conspiracy. It's a stated outcome. Statistics Canada's own data shows GDP per person falling below the pre-pandemic trend. The OECD projected growth of around 1% annually for 2025 and 2026. That's not expansion. That's stagnation with a nice label. The IMF forecast moderate growth of 1.6% overall, but called out structural challenges, weak investment, and trade headwinds. When international institutions use the word structural, they're not talking about a bad quarter. They're talking about a system that's broken at the foundation. Think of this system as a 3-story building. Level 1 is real output. This is where actual goods, services, and value are produced. Factories, farms, construction, energy, real things. Level 2 is financial engineering. This is where central banks print money, governments issue debt, and banks create credit to paper over the gap between what the economy produces and what people want to spend. Level 3 is perception management. This is where media, politicians, and analysts sell you the story that everything is fine, growth is coming back, and your portfolio is safe. As long as all three levels move together, the illusion holds. But when real output at level 1 starts shrinking, the top two floors keep operating as if the foundation still exists, and that's when disaster becomes inevitable. Right now, Canada is in that exact moment. Real output per person has been falling for 3 years, but the Bank of Canada is still talking about stability. Politicians are still promising resilience, and your pension fund is still allocated as if we're in a growth economy. The foundation is cracking, but the top floors haven't noticed yet, and this part has already begun. Let me show you the math that nobody on TV is walking you through. In October 2025, real GDP fell 0.3%. That might sound small, but annualized, that's a 0.5% contraction for the fourth quarter. In 2023, GDP per capita declined in 5 of 6 quarters. That's not a blip, that's a trend. In earlier portions of 2025, quarterly performance was mixed. Some quarters showed modest gains of 0.5% to 0.6%. But the gains weren't broad-based. They were concentrated in a few sectors while the rest of the economy bled. Added up, in just 3 years, Canada's per-person economic output has gone backward. The labor market shows modest job growth, but persistent unemployment pressure in trade-exposed sectors. Business investment is subdued, export performance is weakening, and here's the number that should terrify anyone holding Canadian assets. The output gap, the difference between what the economy could produce and what it's actually producing, has widened. That means we have excess supply, weak demand, and an economy running below capacity. That buffer is gone. The rope holding the balloon down has snapped, and here's where the first domino falls. Here's how this breaks in the real world, step by step. Step 1, the economy contracts in real terms, not just per capita. Total output starts shrinking. Factories slow down. Construction stalls. Exports drop. Businesses that were barely profitable start losing money. Step 2, corporate earnings fall and stock markets react. Your 401k, which is heavily weighted toward Canadian equities or funds with Canadian exposure, starts bleeding value, not a crash. A slow grinding erosion that financial advisors call volatility, but is really just wealth destruction in slow motion. Step 3, governments face a revenue crisis. Tax income drops because there's less economic activity to tax, but spending commitments, pensions, healthcare, debt service don't drop. So they borrow more, deficits explode, and bond markets start asking the question nobody wants to hear. Can Canada actually pay this back? Step 4, the Bank of Canada faces an impossible choice. Keep rates low to support the economy and watch inflation eat purchasing power, or raise rates to defend the currency and crush what's left of growth. Either choice destroys wealth. The only question is, whose wealth gets destroyed first? Step 5, real estate, which has been propped up by low rates and immigration-driven demand, starts cracking. Mortgage holders who stretch to afford homes at 2% rates now face renewal at 5% or 6%. Housing equity, the biggest store of wealth for middle-class Canadians, evaporates. Foreclosures rise. And the banking system, which is heavily exposed to real estate, starts showing stress. That's the cascade. Every step is already visible. We're just waiting for the last domino to tilt. And this is where everything changes. So what does this actually mean if you're an average person in Canada? It means your retirement portfolio, your pension, your 401k is tied to an economy that just admitted it's shrinking, not slowing, shrinking. The funds you're invested in are structured for growth. They assume rising corporate earnings, stable employment, and expanding output. But the economy is doing the opposite. Your portfolio is positioned for an expansion that isn't coming. It means that when the contraction accelerates, when businesses start cutting deeper, when unemployment spikes, the financial instruments you own won't just underperform, they'll crater. And by the time the headlines catch up, by the time the panic hits the front page, the exit doors will already be locked. Pension funds will gate withdrawals. 401k plans will show losses that take years to recover. Real estate equity will vanish as property values adjust to the new reality. Let's zoom in. If you own a home in Canada, your mortgage is likely your biggest financial obligation. You might have locked in a rate years ago when money was cheap, but mortgages renew. And when yours comes up, you're not getting 2%, you're getting 5%, maybe 6%. That's a doubling or tripling of your interest payment. For a household already stretched thin by 3 years of falling per capita income, that's not manageable. That's catastrophic. If you're counting on your pension, understand that pension funds are required to hold government bonds and investment grade assets. But in a shrinking economy with rising deficits, those bonds lose value. Real returns turn negative. And the pension promise you've been counting on gets quietly adjusted, not eliminated, just reduced. Benefits get means tested. Cost of living adjustments get delayed, and the retirement you planned for becomes something less. Here's what that looks like on the ground. Small businesses, which employ the majority of Canadians, operate on thin margins. When consumer spending drops because real incomes are falling, those businesses don't just make less profit, they go under. And when they close, the jobs disappear, not temporarily, permanently. The labor market data might show modest job growth overall, but that's aggregate numbers. It hides the reality that good jobs are being replaced by worse jobs. Full-time becomes part-time, salaried becomes contract, benefits disappear, and your ability to build wealth through employment slowly erodes. But that's not the real problem, because what comes next is worse. The reason most people won't act until it's too late has nothing to do with intelligence. It's psychology. First, normalcy bias. If the economy has been stable for your entire adult life, your brain assumes it will stay that way. Even when Rosenberg Research issues a nuclear report, even when GDP per capita falls for 3 straight years, the default assumption is this is temporary. It'll bounce back. It always does. Except this time, it's not bouncing back. This is structural weakness, not cyclical downturn. Second, the money illusion. You look at your salary, your bank account, your home value, and the numbers seem okay. They might even be higher than they were 5 years ago, but you forgot that the currency underneath those numbers has been silently debased. Your salary went up 3%, but real costs went up 8%. Your home is worth more in dollars, but those dollars buy less. The wealth you think you have is partly an accounting trick. And when the illusion breaks, when prices adjust to reflect the real purchasing power of the currency, the numbers in your account won't protect you. Third, authority worship. If it were real, it would be on TV. If the economy were really collapsing, the Bank of Canada would say so, the government would warn you, your financial advisor would tell you to move your money, but institutions don't announce collapse. They manage perception until the last possible moment. When central banks finally admit there's a crisis, the crisis has already been happening for months or years. By the time they tell you to worry, it's too late to protect yourself. Here's the part even analysts tend to miss. Bank of Canada Governor Tiff Macklem explicitly warned that structural changes and trade uncertainty make economic weakness harder to interpret. He said that misidentifying structural weakness as short-term cyclical slowdown could lead to inappropriate policy responses. Translation: we're not sure if this is temporary or permanent. We're not sure if our tools will work. We're flying blind. And if we get it wrong, the consequences are catastrophic. This is not theoretical, it's observable. The data forces one conclusion: Canada's economy isn't in a normal slowdown, it's in a structural fracture. And the policy tools that worked in 2008 and 2020 during normal recessions won't work now. Let me show you what actually happened. Between 2020 and 2025, Canada added millions to its population through immigration. The stated goal was to support economic growth, fill labor shortages, and maintain tax revenue. On paper, it worked. Total GDP went up. But divide total GDP by total population, and the math breaks. GDP per person fell. That means each individual Canadian became poorer on average, even as the country's total economic output grew slightly. This is where common sense actually becomes your enemy. Common sense says more people equals more growth, more workers, more consumers, more tax revenue. But that only works if productivity keeps pace. If each new person added to the economy produces as much as they consume, the system expands. But if productivity is flat or falling, if output per worker is stagnant, then adding more people just spreads the existing output thinner. You get more mouths competing for the same pie. And the result is exactly what we're seeing: falling living standards, rising housing costs, strained public services, and an economy that looks like it's growing in aggregate but is actually shrinking per person. This is not a prediction, it's math. Statistics Canada's own revisions to income and expenditure accounts in late 2025 confirmed it. Real output is above early 2019 levels in total, but per person output lagged. That's the smoking gun. The economy grew, but the people got poorer, and here is where the cascade becomes unstoppable. Let's talk about portfolio risk. If you hold a balanced portfolio, the typical allocation for someone planning for retirement, you're probably 60% stocks, 40% bonds. That allocation assumes stocks will grow over time and bonds will provide stability. But in a shrinking economy, both sides of that equation break. Stocks fall because corporate earnings fall. Bonds lose value because governments issue more debt to cover deficits, flooding the market with supply and driving prices down. Your financial advisor will tell you to stay the course, ride out the volatility. Markets always recover. But that advice assumes the economy will eventually return to growth. What if it doesn't? What if the structural issues, weak productivity, falling per capita output, trade uncertainty persists for years? Then staying the course just means watching your wealth erode in real terms. You might not see a 50% crash. You'll see a 3% annual loss that compounds over a decade and cuts your purchasing power in half. Here's the moment the clock actually starts. When the Bank of Canada finally admits that structural weakness is the dominant factor, when they stop calling it temporary, the market will reprice everything instantly. Stock valuations will adjust, bond yields will spike, real estate will correct. And anyone who waited for official confirmation will be caught holding assets that are suddenly worth far less than they thought. This is where the part that scares me begins. Because the policy response to structural weakness isn't more stimulus. Stimulus works when the problem is lack of demand. You print money, people spend it, and the economy recovers. But if the problem is lack of supply, lack of productivity, lack of real output, then printing more money just creates inflation without creating growth. You get stagflation. Prices rise while the economy shrinks. And that's the nightmare scenario for anyone holding financial assets denominated in the currency that's being debased. For the average household, this means your credit risk just went up. If you have variable rate debt, credit cards, lines of credit, home equity loans, the cost of servicing that debt is about to spike. Interest rates might stay elevated for longer than anyone expects because central banks will be caught between fighting inflation and supporting growth. They can't do both. And whichever one they choose, you lose. Let me be precise about what happens to real estate. Canada's housing market has been driven by three factors: low interest rates, immigration-driven demand, and the belief that prices always go up. Two of those three factors are now reversing. Interest rates are higher and might stay higher. Immigration is being questioned politically as the economic benefits fail to materialize. The only remaining support is belief. And belief is the most fragile foundation of all. When mortgage holders start renewing at rates double or triple what they locked in, some will be forced to sell, not because they want to, because they can't afford the new payment. Those forced sales will set new price comps, and those comps will be lower, much lower. As prices fall, other homeowners will see their equity shrink. Some will go underwater, owing more than the home is worth, and the banking system, which is heavily exposed to real estate through mortgages, will face rising default risk. This is the crack that becomes an earthquake. Canada's banks are considered among the safest in the world, but that safety is built on the assumption that real estate holds value. If real estate corrects 20%, 30%, the capital buffers that protect the banks shrink, not to the point of failure, but to the point of stress. And stress in the banking system means credit tightening, loans become harder to get, business investment falls further, and the economic contraction accelerates. We haven't even reached the breaking point yet. Here's the domino sequence. First, GDP per capita continues falling, consumer confidence drops, spending slows. Second, businesses respond by cutting costs. Jobs are cut, investment is delayed. Third, unemployment rises, not dramatically, but persistently. The labor market softens, wage growth stalls. Fourth, tax revenue falls, government deficits widen, bond issuance increases. Fifth, the Bank of Canada faces the impossible choice: support growth with low rates and accept inflation, or defend the currency with high rates and accept recession. Either way, wealth gets destroyed. And here's where everything changes, because at some point, markets will stop believing the official narrative. They'll look at falling per capita GDP. They'll look at widening deficits. They'll look at structural weakness that isn't being addressed. And they'll ask the only question that matters: what is Canadian sovereign debt actually worth? When that question gets asked seriously, bond yields spike, the cost of government borrowing explodes, and the entire fiscal structure of the country comes under pressure. For pensions, this is catastrophic. Public sector pensions are backed by government bonds. If those bonds lose value, pension funds take losses. Private sector pensions invest in a mix of stocks and bonds. If both fall, the funded status of the pension deteriorates, and the promise that was made to retirees, a certain income in retirement, becomes harder to keep. Benefits get cut, payouts get delayed, and the retirement security that people spent decades building evaporates. This part isn't a prediction, it's math. The data is unambiguous. Let's cut through the noise. What I call the big secret of the entire system is this: modern economies don't run on production anymore. They run on credit. And credit only works when people believe in future growth. When GDP per capita falls for 3 straight years, that belief starts to crack. Lenders get nervous, borrowers get cautious, and the entire credit mechanism that keeps the economy moving starts to seize up. This is vanishing in real time. Business credit is already tightening. Bank of Canada data shows lending standards have gotten stricter. Approval rates are down. Interest rate spreads are widening. That means even businesses that want to invest, that have good projects and solid plans, are finding it harder to get financing. And without credit, businesses can't expand. They can't hire. They can't invest in productivity improvements. The very thing the economy needs to escape the structural weakness becomes impossible to achieve. For households, credit tightening means something different but equally destructive. It means access to mortgage financing gets harder. Down payment requirements rise. debt-to-income ratios get scrutinized more carefully, and the dream of home ownership, already strained by falling real incomes, moves further out of reach for an entire generation. That's not just an economic problem, it's a social and political powder keg. Here's the part nobody expects. When an economy enters a disinflationary output gap, the standard playbook says prices should fall. Less demand, more supply, prices drop. But that's not what's happening. Prices are sticky. Housing costs stay high because existing homeowners won't sell at a loss. Food costs stay high because global supply chains are fragile and input costs haven't normalized. Energy costs fluctuate but don't collapse, so you get the worst of both worlds: shrinking real incomes and persistent high costs. Purchasing power gets crushed from both sides. This is the detail even analysts tend to miss. Disinflationary doesn't mean deflation. It means inflation is slowing but still positive. Prices are still rising, just not as fast. So your real income, which is already falling because GDP per capita is falling, continues to lose ground to inflation. Even if inflation drops from 4% to 2%, if your income is growing at 1% or shrinking, you're getting poorer. And that process compounds. Year after year, your purchasing power erodes. The retirement you planned for costs more than you saved for, and the gap between what you have and what you need widens. Let me show you what this looks like in portfolio terms. A typical retirement account holds mutual funds, index funds, maybe some bonds. Those funds are diversified, which sounds safe. But diversification doesn't protect you from systemic risk. When the entire economy is in structural decline, everything falls together. Canadian equities fall because earnings fall. International equities fall because global growth is slowing. Bonds fall because governments are issuing more debt. Even real estate investment trusts fall because property values are correcting. Your 401k statement might show you're still up over 10 years, but that's nominal returns. Adjust for inflation, adjust for the real purchasing power of the currency, and the picture is very different. You might have gained 20% in dollar terms, but lost 10% in real terms. Your advisor won't frame it that way. They'll celebrate the nominal gain. But when you go to withdraw that money in retirement, you'll discover it doesn't buy what you thought it would. And by then, it's too late to adjust. This is where the countdown quietly began. The moment GDP per capita started falling consistently, the clock started ticking on a series of inevitable consequences: falling incomes, rising debt burdens, tightening credit, weakening asset values, and eventually a breaking point where the system can no longer paper over the gap between what it promises and what it can deliver. Here's how the final phase unfolds. Governments facing unsustainable deficits and rising debt costs will be forced to choose. Cut spending, which means cutting services, cutting pensions, cutting benefits, or raise taxes, which further suppresses economic activity and accelerates the contraction, or debase the currency, print money to cover the gap, and let inflation destroy the value of existing savings. None of these options are good. All of them destroy wealth. The only question is, whose wealth gets destroyed? High net worth investors will move capital offshore. They'll shift into hard assets, commodities, foreign real estate, anything that holds value outside the Canadian dollar. They'll use tax structures and legal entities to protect themselves. But the average person doesn't have those options. Your retirement is locked in a 401k. Your savings are in a Canadian bank. Your wealth is denominated in Canadian dollars. And when the adjustment comes, you'll take the full hit. This is not conspiracy. It is stated policy. The Bank of Canada has already warned about structural weakness. The OECD has forecast slow growth. The IMF has called out investment headwinds and trade uncertainty. The data is public. The warnings have been issued. But the implications, the real consequences for your portfolio, your mortgage, your retirement, are not being spelled out clearly. That's not because officials are hiding the truth. It's because the truth is so uncomfortable that nobody wants to say it plainly. Let me be clear about what's at stake. If you hold Canadian bonds in your portfolio, you're holding an asset that pays you in a currency that's being debased. Even if the bond doesn't default, even if the government makes every payment, the real value of those payments is shrinking. You might get back 100% of your principal in nominal terms, but that principal will buy less than it did when you invested. That's not a technical loss. It's a real loss. Your wealth preservation strategy just failed. If you hold Canadian equities, you're holding ownership in companies operating in a shrinking economy. Some will survive, some will adapt, but the aggregate performance of the market will reflect the aggregate performance of the economy. And if the economy is contracting per capita, corporate earnings will follow, stock prices will adjust. And your equity exposure, which you thought was positioned for growth, will underperform for years. If you hold real estate, you're holding an asset whose value depends on credit availability, income growth, and population demand. All three of those factors are under pressure. Credit is tightening, incomes are falling, and immigration, the driver of housing demand, is being questioned politically. When those supports weaken, prices correct. And the equity you thought was safe, the wealth you thought was locked in, evaporates. This was inevitable the moment the structural issues became clear. You can't grow an economy by adding population while productivity stagnates. You can't maintain asset values while real incomes fall. You can't promise retirement security while pension funds hold depreciating assets. The math doesn't work. And at some point, the market forces the adjustment that policy refused to make. I can't tell you what to do, but I can tell you the only question that matters now. Do you own real assets or do you own claims on assets? If you hold mutual funds, ETFs, bond funds, you own claims. You own a promise that someone else will pay you, but promises are only as good as the ability and willingness to fulfill them. If the system is under stress, if the economy is contracting, if governments and corporations are struggling, those promises become harder to keep. If you hold physical assets, real estate you control, commodities you own, businesses you operate, you own reality, not promises, reality. In every crisis in history, the people who walked out intact weren't the ones with the best charts or the most sophisticated financial instruments. They were the ones who quietly moved from promises to reality before everyone else. They understood that in times of systemic stress, counterparty risk becomes the dominant risk. And the only way to eliminate counterparty risk is to eliminate the counterparty. Here's what that means in practical terms. Understand your portfolio exposure. Look at what you actually own. How much is in Canadian assets? How much depends on Canadian economic growth? How much is denominated in Canadian dollars? Then ask yourself, if the structural weakness persists, if GDP per capita keeps falling, if the currency weakens, what happens to those holdings? Not in a crash, in a slow grind, because that's what structural decline looks like. Not dramatic, just relentless. Manage your debt risk. If you have variable rate debt, understand what happens when rates stay higher for longer. If you have a mortgage coming up for renewal, plan for higher rates now. Don't assume rates will fall back to where they were. Assume the opposite and structure your finances accordingly, because the difference between managing debt risk and being overwhelmed by it is preparation, and preparation requires acting before the crisis, not after. Preserve purchasing power. This is the goal that matters, not nominal returns, not beating an index. Preserving the real purchasing power of your wealth. That means thinking about what your money will buy in 5 years, in 10 years, in retirement. and structuring your assets to protect against currency debasement, against inflation, against the slow erosion that comes from holding promises in a system under stress. They blamed it on temporary weakness. They called it a cooling economy. They said resilience would carry us through, but you now know the truth. The Canadian economy didn't stumble. It finally tripped over the math it's been ignoring for 3 straight years. GDP per capita has fallen. The output gap has widened. The structural issues are real, persistent, and not being addressed. And the consequences for your retirement, your mortgage, your wealth are just beginning to unfold. In the next episode, we're going to look at how central banks respond when the illusion breaks, the 3 policy tools they always reach for, and why all 3 destroy wealth in different ways. We'll examine the historical playbook from other countries that faced structural decline, and we'll break down the specific timeline, the specific triggers that could accelerate the adjustment from slow grind to sudden crisis. Stay vigilant, stay informed, and above all, stay out of the paper promises.